Hey guys, this is Kirk here again at Option Alpha. It is late on Wednesday night, so had a lot of coaching this week, a lot of coaching in general, which is good. But I wanted to get this video done tonight, and you guys will obviously be seeing it tomorrow morning. But I want to get it done tonight because I wanted you guys to see all the pricing structure for the RUT credit spread while it's out right now. Because in the morning they start erasing the pricing for the next day. So, what I had planned to do on this video is go through the RUT credit spread that we currently have. It's that put spread that we entered a while back and has been fairly close to the market. And I've been updating you guys on where I think things would go and my kind of plan earlier in the week. And things have turned out actually really well, and I'm glad at where the market's going. I thought that the market was going to have a good rally here, and it did for the last 2 days. So we've gotten a really good rally. I think we could have a 1 day decline here or two heading into the end of the week. And then obviously Friday, who knows what's going to happen with Bernanke, right? So everyone's already priced in, the fact that he's going to continue to prop up the market. Who knows about a QE3 or not. But I do think it's prudent at this point, with where the VIX is at and where the market is in general, that we take advantage of the market now and roll this credit spread lower, just to give ourselves some extra room. So I want to go over the intricacies of them here on this just slide here that I put together for you guys. And then I wanted to get to the chart and the pricing structure so you can see and verify all this. Now, obviously, the only position that we have right now for September is this RUT credit spread. So we're going to be entering more positions, which is going to be good, and it's going to eat away at the minor loss that we have here. Oddly enough, we actually did really good in August and kept our profit in August for our credit spread portfolio. So I'm really happy about that. I think that we can definitely eat away back at this minor little loss that we have here now with some more positions, because we have 2 extra positions that we can enter for September expiration. So what I wanted to go through here on this credit spread slide here is obviously just the intricacies of the pricing of the roll, and then I'll show you guys. So we have currently the 650 640 RUT put credit spread. The initial premium that we got was $50, so that's what we took in. Now some of you took in a little bit higher than that as the market was rolling down, but we got $50. We're going to buy back this spread for $215, so that's going to be the price, $215 to buy back the spread. Then we're going to actually move down to the 600 590 level, and I'll show you on the chart why I think that that's a good level right now too. And we're going to get a premium of $120. Now these may not be the exact premiums that you get tomorrow in the market. They may be 220 and 125, or 110 and 205. The most important thing is that we keep the debit between these two at roughly 90 to 95. That's what we want to shoot for tomorrow. So make sure that when you're pricing in your trades and your rolls, that's what you shoot for. Don't these premiums are just what they closed at today, but the most important thing is the spread between them as you're rolling it down. So once we factor in all of those, the $50 credit that we had, using some money to buy back at $215, and then reselling and getting another credit of $120, we get a net debit on the trade of $45, or an overall return, if expiration is worthless, of 4.7%, or negative 4.7%. So again, a nice small little loss. I'd rather take small losses now than some of the 20, 40, and 50% losses I've seen out there. And we do have some room in the portfolio to add some really good positions that can definitely eat away at that loss very quickly. So now when we go to the actual thinkorswim here, and you can actually see, I'll go to the trade tab in the RUT. I have up here from today the 650 640 credit spread, and so you can see that we're going to be buying that back. So not a sell order, but a buy order, and the pricing on it today closed at 215. And then again, you can verify right here where my cursor is that the 600 590 spread is actually trading at about 120. So some really good volume in that today as well too. And you can see that actually most of the volume is actually centered around, and actually the open interest, anywhere between the 610 and 630 region. So that's where most of the activity is. We're just going to be just one set of strike prices below that, which I think is going to be really good. If you go to the chart of the RUT, you can see where our current position is at 650. So again, it's a little bit too close for my comfort, and I think we played it really good all during the kind of mini crash that we had in August. I think that was good, just waiting. Again, I think it was good just waiting the last couple of days here. But I don't want to get too naive in that the market can't continue to sell off from here. So we're going to be moving down to the 600 level, which is going to be really good. Again, giving us some extra room below the market here. I think the 600 level is going to be really good for us because I think that that's another couple percentage points below what the market might do. If the market does continue to sell off, I don't think it's going to get much past 620, 625. That's going to be really strong support for the Russell going forward because historically, it's seen a lot of activity in that type of range. So I think 625 is going to be a pretty good line in the sand if we start to roll down. Obviously, we could continue straight higher from here, but I just don't know if I see that happening right away, and I'd rather take a position and roll it down lower while we can than get stuck with it right at expiration. So that's the whole plan behind the trade. As you know, with this alert, and if you check the other alerts, this morning I also sent out a naked puts and calls alert. So the VIX is still relatively high, which has been really, really good. Even with the last couple of days, the VIX has only come down. I say only to 35. So it's still very high. Premiums are really swelled. And as you guys know, I've sent out emails about 700 put options on the S&P that were trading at 120. Well, they're back down to like $25 now, which is still a good, return if you just want to get a couple dollars here and there and kind of fill up your portfolio for the month. But it just really goes to show you how wide and spread these premiums can swell when the VIX is up here. So we want to take advantage of it now before volatility continues to fall, if it does. And of course, if it starts to jump, then we'll just add positions. We have a lot of flexibility in the portfolio this month, a lot of room to grow and a lot of room to move with the market. So, and that's what I wanted to do overall, and I'm glad that we're continuing to do that. Not over trading in this market, but definitely taking advantage of some opportunities. So, as always, I hope this has been a helpful video, and you guys can add your comments, questions, feedback, all that stuff to this post as always. And happy trading.